Part of this video will be to go through my 2023 revenue and earnings forecast for CloudMD. On the way to getting there, I'm going to go through the Q1 numbers and comments and highlights from the conference call. And then we also had the sale of the electronic medical records in the US to Harris, which is a division of Constellation Software, which is one of my favorite stocks, and it's in the top 3 or 4 of my holdings. So just before I get to Q1, just a reminder of exactly what CloudMD looks like and the new language they're using. We now have health and wellness services. This is the old enterprise health services, health and productivity solutions, smaller part of the company. That's the old digital services. There's no more clinics and pharmacies. Anything left over, normally RXI, is under discontinued operations. So no structural change to the company, just a name change. So the two divisions, 75% of their revenue roughly comes from the health and wellness services, and the remaining 25 comes from the health and productivity solutions. I put an arrow towards Benchmark, one of their many parts of the old digital health services. With the sale to Harris, they probably lost revenue under this subsection of the company. And then the other major piece in the health and productivity solutions is Vision Pros, which I always try to model, but I find it difficult to get enough information to exactly model what Vision Pros is doing. Quick recap of last year's revenue. It's really tough looking at financial statements this year going back because the company is totally different from Q2 to Q3 of last year. We have the old clinics and pharmacies that were sold, so it looks like we have this colossal drop in revenue, but it's just a different company. So looking back year over year, I find is pretty useless. Quarter over quarter is what's most beneficial when we go through their financial statements this year. So it's not like all of a sudden the company had this colossal revenue drop because sales fell off a cliff. It's just no more clinics and pharmacies. Now, what I'm going to try to do, and I'll come back to this slide at the very end, is before I only modeled what's at the very top, what I thought their divisions were going to make, and now I'm sort of going to use their financial statement and try to model that going forward. So I'm going to model out all their indirect expenses, and as I work my way through the Q1 MD&A, I'll highlight the comments that led to the numbers that I have in this slide. So from their Q1 MD&A, from their summary part, they talked about their revenue from continued operations. So there's no pharmacies here anymore. RXI is under discontinued operations. And we finally hopefully hit a trough or bottoming out on their revenue. There's no more one-time mandates coming as we leave COVID. So things should be up from here other than that sale to Harris. We do continue to see sort of negative Vision Pros revenue come in. So that's disappointing, particularly with what they've paid for the company. But they still expect their health and productivity solutions business to have organic growth going forward. So I didn't get sort of hints on future Vision Pro revenue. Their gross margins are sort of fairly stable in the 36 range, even though there's been a lot of change in the company over the year. So I'll continue with sort of the 36 range. I'm hoping for this to increase, but I'm not modeling it in the second half of the year. Their adjusted EBITDA has been improving. Again, we don't want to look year over year. I don't. It's just such a big change with the clinics and pharmacy business. But they did have a 0.9, almost $1 million improvement in adjusted EBITDA. And this will be a big thing that I'm trying to model out for the rest of the quarters. They had a $1 million annualized run rate of cost improvements in the first quarter. And then what's most crucial for me modeling out is a $4 million annual run rate cost reduction to be realized in the second and third quarters. So I'm going to, by the third quarter, be doing a full $1 million per quarter, and I sort of just do a little bit of that in Q2. So hopefully I'm a little light in my numbers of of how quickly they are going to get these cost savings through the financial statements. So I'm like 20% here, the full 100%, or the other 80 in Q3. Sort of very useful information in modeling the organic growth. So they signed annual recurring contracts of 2.9 million during the first quarter. So that gives them an expected run rate or growth rate of 11%. Now I'm going to model higher than that, particularly a little bit higher in the second quarter. But this should set a floor, a bottom. Okay, and they talk tons about cross-selling. So as they acquire a customer, they can sell to that same customer. The fastest growing part of their business is the health and wellness services side. I'm almost surprised, or wouldn't be shocked, if they turned almost the whole business into this health and wellness in the future. I don't personally see how Vision Pros fits into CloudMD. It seems like it must, low margin, high cost of customer. I don't see the growth there. So the old digital health services, I'm just curious what will happen with that over time. So kind of looking for tangibles for what they've actually done. They've talked a lot about cost savings, and I've kind of just highlighted the Q4 select financials is on the left, and we've got Q1 on the right. So sales and marketing did drop substantially. They talked about a massive drop in Vision Pro sales and marketing. So that's probably leading to the decreased revenue also. Research and development did not drop, so I don't continue to drop that going forward this year. A nice little drop in the G&A. Depreciation and amortization, pretty steady. And sort of their acquisition divestments line dropped significantly, and that's certainly talked about. Okay. So in these indirect costs, or in the top, R&D, G&A, and sales and marketing, I take $1 million over the next couple quarters out of these in my projections. I pretty much model everything above the orange, and I feel reasonably comfortable that I should be in the right ballpark of modeling down to net loss. But below this is a lot more tricky for me to model, and there's a lot of unique items quarter to quarter. So Outlook, again, this is coming from the MD&A. They never talk about buying companies, buying growth, adding to pieces. It's always they need to integrate all these acquisitions, have synergies, the cost cuts. They're very transparent with the cost cuts they expect to have. And I like this. They're intending to improve gross margin. So I'm not modeling this yet, but hopefully that 36% gross margin can improve. And we got a nice answer or guidance on this in their Q&A in their conference call. So I'll come back to that margin part. Okay, and they talk about generating positive or profitable growth in both divisions. Again, to me, this is the main division, and I'm really curious 2-3 years out what's going on in their solutions as opposed to their services division. Some other comments. A lot is focusing on Q4 in terms of being. Now, they play with the wording a little bit. They talk about being cash flow positive. In the future, they're a bit more specific at the bottom. Okay. Becoming cash flow positive isn't all going to be cutting costs. They definitely need to get some key client wins. They've talked about that regularly, and reduce costs. I'm assuming that by Q4, the end of the year, they probably will have a pretty lean company, and going into 2024, it's going to be the client wins that's going to drive this company, where cost savings is a big piece now towards profitability. Cash outflows from non-recurring integration will decline, so that's a line item that I'll be declining in my estimates. I highlight several times this $4 million cost savings, annualized $1 million per quarter. During the year, they expect to have low double-digit growth. Again, I'm hoping this is a bit of UPOD or under-promise, over-deliver. I'm modeling a little more mid double-digit growth. And then adjusted EBITDA break even, they expect to have that in the fourth quarter. So I don't view adjusted EBITDA break even and cash flow as exactly the same. I wish they'd just pick one bit of wording and stick to it. But here where they're most specific, it's adjusted EBITDA at the bottom of their financial information in Q4. So now into the conference call. Karen opened it up. I'm not going to highlight anything initially in her statements. Again, lots of talk about, their first division, their main division. That's always what they're talking about in terms of, or largely talking about in terms of growth in the company. So that, that's what she talked about first. I know it's a bigger piece, but again, I think it's the more important going forward. Then their CFO added some comments for the third or fourth time, talked about those cost savings, low double-digit revenue growth coming off Q4 as their basis. They talked about a decline, what's going on with their health and productivity solutions business, drop in Vision Pro's revenue. They talked about a drop in Vision Pro's marketing in the MD&A, but they still believe they have a strong pipeline in their division. So without comments like this, I'd be tempted to model maybe flat or potentially even negative revenue in the solutions business, but I'm still modeling positive revenue growth. They do expect to have significantly less one-time costs in this quarter. This comment is about their costs, and sort of have to piece all these comments and sort of I had to make some judgment calls of where the $1 million in costs were going to come from in terms of sales and marketing, general administrative, and research and development. Now there was I thought a really good answer to a question. I'm not going to talk about all of the Q&A comments. I thought most of it just was repeated information. But Laurentian's, I believe it was Laurentian's analyst, Nick, asked a good question and we got a fabulous answer. So he's just wondering, if we look 3 to 5 years out, what does the business look like in terms of growth and margins? And we got a very specific answer. And in a future video and for myself, I want to sort of model out 3 years and apply these margins to it. I just haven't quite done that yet, and I haven't decided what EBITDA margin I want to use to get a value for the company and then sort of discount it back to today. So it hasn't been done yet, but it's something I want to do. So John, the CFO, says, so I think the business today and the services we're offering is going to lead to a 40% gross margin. So they're about 36 right now. And again, they're never over promising. So hopefully it'll be better than 40. They constantly use the word very achievable in their answer. So not maybe or stretch target. Okay. They think that it's the health and productivity tools are going to help drive margins. So that's the old digital health services. So they still talk positively about that. In terms of adjusted EBITDA, high teens to 20, they think is, again, we have this very reasonable, not a stretch target. So I want to use 40 and 20 to do some modeling out in the future. So I thought this was a really nice answer. I've been wondering sort of where CloudMD is going to go. I'm hoping, and will only stay an investor if I think they can have sort of 20% revenue growth. They talk somewhere in the MD&A about this industry in the U.S. growing at 30% per year. So they need to be growing at more than 11% per year, and they haven't said what their real goals are and shouldn't. But I'm hoping to see accelerated revenue growth and more and more of that fall to the bottom line. Karen, just sort of on the same question, talked about remote patient monitoring as being an important area, and that showed up a few times in the MD&A, and then it showed up here. So I just wanted to highlight that. Super quickly, before I get into my model, they did sell their electronic medical records in the US. I think 35 states is what I think their benchmark division says they're in, for $6.3 million US, again, to Harris, which is part of Constellation Software. Now, Constellation is a 7-8% weighting in my portfolio, where cloud is 1%. So anyway, Constellation is much more important to me than this company. So that just piqued my interest. This is a tiny sale for Constellation, or a tiny pickup. So I had to try to figure out how much revenue to take out. And again, I'm assuming it's coming out of this benchmark systems. So I was kind of undershooting it. I was going to guess around 3-4 million. But Rob at Echelon Capital came out with a note, and he's using, I think, 1.2 times revenue to enterprise value for this division, so close to a 1-to-1 ratio. So I'm really using his numbers to decide how much revenue to take out starting in Q3, though I might be a little early with removing that revenue. So kind of jumping into my financial projections for the year. This is sort of my full spreadsheet working back from 2021. Anything in blue is actual numbers from the company. Anything not in blue, in particular in yellow, are my estimates, the yellow, gray, light yellows. So if we sort of focus in a little bit more, just looking at Q4 and then Q1, I'm basically modeling out all of these indirect revenue expenses that are in their selected financial information. So working sort of from the top from revenue, I'm using sort of more mid-teen growth rate, so stronger than the 11 floor the company has given, particularly more in the second half. So the health and wellness services division is here. So this is from a Google sheet, and there's percentages buried into these from quarter to quarter. So even though, and these are rounded numbers, so it's not me just punching in guesses. It's all percentage based. Digital health, the old digital health services, the solutions part of their business. We don't get it from the company, but I always try to break out Vision Pros from others. And this is definitely a bit of guessing, because they don't give us clarity on these. In my previous video, I talked about where I get my Vision Pro estimates from. So I'll just highlight that starting here, I have a $1.5 million per quarter drop in revenue due to the sale to Harris. So that's why we see the drop here, but I'm still modeling, I think 4% quarter over quarter growth. The Vision Pros is very lumpy, but all I've done is sort of used a consistent revenue increase, which isn't going to be the truth, but it's the best I can do to model. So the two divisions lead to our revenue projections for each quarter, and then I use, I'm staying in the 36%. I'm hoping this will drift up even more than this. And then from the margin, I can back calculate the cost of sales and get the gross profit numbers. Then all these indirect expenses being using the same ones as their financial statement. Now in Q4, they had this impairment line that doesn't show up in the Q1, so that's why that stays blank. So to kind of simplify this, by Q3, this is down, or at least the top three are down $1 million. That's what they've said. Stock-based compensation have left the same. Depreciation and amortization I've left the same. It was pretty stable from Q4 to Q1. Acquisition related has a huge drop, and they talk about that continuing to drop. So I've kind of guesstimated a bit what that drop would do. And then there's no talk of impairment. So when you add up all their indirect expenses from their gross profit, that's where I get the operating gain, or it's been a loss. So the brackets mean loss. And this orange arrow is saying I'm reasonably certain, or I should be in the right ballpark at least with that number. Now it gets a lot trickier. I don't sort of break out every line item getting down to adjusted EBITDA. Now, I may have some errors in my assessment, but there's a lot of line items that sort of cancel each other out between here and the very bottom. So share-based compensation is sort of put in and taken out, and depreciation, amortization sort of shows up, and then in the EBITDA, it's removed. So this middle, I wouldn't put too much weight in, but I think, again, it's the two orange arrows that I'm most concerned about. So I'm getting pretty close to adjusted EBITDA positive in Q4. I didn't rig this number to make it 0. This is sort of what it came out, and I left it. It didn't seem like good analysis to try to retweak things. I was tempted to add a little bit more revenue to get this to 0, but I don't think it's a good idea. Now, I'm coming in 3 or 4 million higher than Rob from Echelon Capital with his projections for the year. So I'm in the same ballpark as him. Normalized cash flow and cash balance and long-term debt, I don't intend to model those, but the normalized cash burn has been coming down. All my numbers here are in millions, unlike the financial statements that are in thousands. Now, long-term debt and cash are pretty similar, so the enterprise value and market cap of this company is pretty much the same. So doing some mental math in my head, there's 300 and some million shares at 13 or 14 cents. There's 35, 40 million of enterprise value for CloudMD, which does seem quite low compared to at least the revenue. They're trading a third of revenue. So my gut is they're fairly cheap. They just have a really complicated business for people to understand, particularly going back with, when you go back a year, things look horrible because you have that way higher clinics and pharmacy revenue. So we'll see how my numbers look when Q2 revenue comes out, and then I expect I'll readjust Q3 and Q4 because we'll probably get we'll get better information about exactly what revenue was lost with the sale to Harris, and I'll get some more Vision Pro revenue, and we'll get some more information on what annualized recurring revenue contracts they've been able to sign. So my thoughts and what's next, I do want to go through Rob's note from Echelon Capital in a bit more detail, compare his revenue to mine, maybe decide whether I should take a little bit of revenue forecast off mine. Again, I just talked about that once we get the Q2 earnings. Typically, it's late August. I'll be able to update my Q3, Q4 numbers and probably start into a 2024 projection. This company should be coming a lot easier to model as we go into the future, becoming a lot more stable. Again, I want to go through, I mentioned halfway through the video of wanting to do some modeling of, what do things look like under 40% gross margins and 20% adjusted EBITDA. I just didn't bother typing in adjusted here. So, maybe project a 15-20% growth rate out 3 more years and apply these numbers and see what type of adjusted EBITDA I get. And again, I haven't decided what EBITDA margin I want to apply to this. I want to look at Well a little bit, but I don't find there is a really nice comparable to Cloud. I think Well grows faster and is a very different business. So again, I'm a little sure, 7-10 times what EBITDA margin should I use. And when I'm done all this, I might pick up some more shares. Cloud is a little bit under 1% of my portfolio, so I could easily add another 0.5% or 1% at most. Cloud is not a 10, 15, 20% part of my portfolio. It needs to be small. If cloud went to zero, it really wouldn't. I don't think it's going to at all. I like it because I like the balance sheet, but stuff like this you have to be able to live with if it did go to zero. And I certainly wouldn't put 20% of my net worth into something this small. Maybe if I was 21 or 22, but I think there's better companies to something faster growing if I was super young and wanting to take risk. So hopefully this gives you some idea of what the company's like, where it's going, and what type of revenue and earnings it might have in the future. If you did like this video, please consider hitting the like button and subscribing, and you probably won't see an update on CloudMD from me till late August.